Today, crypto broker Genesis cuts a fifth of its workforce. A judge tells Celsius it can keep selling mined Bitcoin through bankruptcy. And as more lawmakers consider stablecoin rules, is the industry in for a major crackdown? Welcome to CNBC's Crypto World. I'm Kate Rooney. It's another day of losses for digital currencies. By noon Eastern, Bitcoin traded around $23,000, Ether dropped to $1,800, and Polygon fell to 89 cents. All right, on to the top stories. First, Genesis is slashing jobs. The crypto brokerage firm announced it would cut 20% of its 260-person workforce. CEO Michael Morrow is also stepping down, and the company's COO will take over until a permanent replacement is found. Genesis was the largest creditor to Three Arrows Capital and filed a $1.2 billion claim against the failed hedge fund. Next, the judge overseeing Celsius's bankruptcy will let it continue selling Bitcoin. Celsius Mining, which is a subsidiary of Celsius, can mine and sell Bitcoin during the bankruptcy proceedings. Celsius Mining isn't making money yet, but an attorney for Celsius said it was close to profitability. The judge did express concern over the lack of profit, but said he would trust the company's judgment. Finally, Crypto.com just registered with UK regulators. The crypto exchange joined the Financial Conduct Authority's list of crypto exchanges to comply with anti-money laundering and terrorist financing rules. The FCA has been strict on crypto exchanges trying to join its registry and said in July that it would be, quote, hawkish around consumer protection when it came to crypto. All right, for our main story of the day, we're sticking with regulation, this time in regards to stablecoins. UK lawmakers are considering a bill that would direct the Bank of England, the FCA, and other agencies to enforce rules for stablecoins. And the UK is not alone by any means. The US, EU, and more are all considering new rules for the industry. So is this a crackdown on stablecoins or a much-needed regulation? Crypto World's Jordan Smith spoke to Jeffrey Blockinger of Quadrata to learn more.
So we're seeing new waves of regulatory scrutiny for stablecoins out of multiple countries. Is this a crackdown that we're seeing right now, or is this much needed regulatory guidance that could be coming soon?
Yeah, I don't think of it as a crackdown. I really think of it as more of a natural progression of regulation, where you've got a new asset class that, quite frankly, mirrors an existing asset class, and you're having regulators starting to pay attention, and especially in light of what happened earlier this year with the Terra meltdown. To me, it makes a lot of sense. But that being said, the attention that stablecoins have been getting by global regulators has started years ago, and my expectation is that it's going to continue.
What are some of the most needed regulations in the industry? I mean, for so long, people have been talking about crypto needs more regulations. They'll play by whatever rules are given to them. But what rules should people expect for stablecoins?
I think what we've seen in the past few years has been initially a focus on transparency, which also included conversations about the quality of the audits that were taking place in the space. Now it appears that the attention is being turned to whether or not the reserves that are behind stablecoins are certainly enough, and whether the actual assets that are serving as reserves are appropriate assets. Finally, I think that we're going to see a lot of regulation around their use. And, that's one of the things, for example, that Europe's focused on is, really what are the limits on the trading volumes, and, what should be the limits. We're going to see a lot more stuff. But, one thing to keep in mind, that you often see parallels drawn between stable coins and money market funds, for example. And, don't forget that, the initial money market fund rules, which is Rule 2A7 under the Investment Company Act of 1940, were adopted decades ago. They were amended as recently as 2015, and they're going to continue to be amended. And so this is a conversation I think is going to continue for a long time. But I don't think it's going to shut down the industry.
I think one of the comparisons we often hear is stablecoins could be treated as money market funds on steroids. But in terms of rulemaking here, would regulations around reserve requirements or liquidity be a good thing for the industry, or could it hurt certain stablecoins more than others?
So look, you're talking to somebody who's coming out of traditional finance, and you're seeing a lot of people move from traditional finance into the cryptocurrency ecosystem these days. So, my natural inclination, having lived through regulated industries for the better part of my career, is, I'm a general believer that some level of regulation is going to help. But similar to traditional finance, it continues to be, the conversation continues to be, is it appropriate levels of regulation or is it too much? And especially in this asset class where we're not just dealing with new financial products, let's call them, we're dealing with a new technology that not only has a financial use, but has a use related to things like banking the unbanked and allowing payment systems across borders to become significantly safer and significantly more efficient. And one really hopes that regulation doesn't shut that down because it's a really important part of this technology.
I think of algorithmic stablecoins. Those seem to be most likely to face the most scrutiny. What kind of changes could lawmakers focus on there? I mean, is it a situation where we could see algorithmic stablecoins restricted broadly in some places?
I think it's certainly possible, and I think it may even be likely. The situation that happened with Terra earlier this year was an example of what goes wrong with new technologies. Now, that being said, no new technologies work from day one, and they all need to be developed. That being said, as we talked about earlier, there is a benchmark for regulators to be looking at, which is money market funds. And they're going to, my prediction is that the regulators will continue to be very skeptical of algorithmic stablecoins. We're seeing proposals in Europe that essentially would shut them down. My sense is that those proposals will gain more attention around the world, and I think we'll see it with other regulators. So, we'll see what happens with algorithmic stablecoins. My sense is that the industry will continue to want to use technology so that the expense associated with building these tools is lesser, but it remains to be seen if that's going to be possible.
We've seen so many bills out of Congress in the US this year regarding crypto. What's the likelihood that we see any movement in those in the near term, say by the end of the year?
I think it's very unlikely. Even before the Terra collapse, it was unlikely. I think some of us in the industry who have seen events like that encourage aggressive congressional action. We're expecting that perhaps that could have been a catalyst, and that didn't happen, best we can tell. Even those involved in writing the current bills that have been drafted in the Senate are saying that it's unlikely that these are going to be adopted this year, which to me says it's really unlikely.
What's the negative impact for businesses in regards to that? I mean, there's been conversations about a flight of talent out of the US if we don't get some sort of regulatory guidance that would allow these businesses to build up. I mean, the longer that we draw this out, is there a real risk that we could see talent leave?
Look, I think there's a risk that you could see talent leave. I'm not sure that that's going to happen. You heard similar statements come out of the hedge fund industry 20 years ago when the regulatory infrastructure was being built around that industry. That being said, it makes it significantly more expensive and significantly more difficult to develop when there's not a clear regulatory infrastructure. And again, like I mentioned before, so many of us are now from traditional finance. So many of us from traditional finance have gotten into this space. We're looking for those benchmarks to allow us to continue to help the industry develop. And until that happens, it's going to make it more complicated, more expensive. The risk of regulatory exposure and regulatory enforcement is going to be significantly higher. And none of those things are constructive if you're trying to build out new technologies.
All right, that's it for today. We'll be back again tomorrow with a lot more. We'll see you then.